Now, the statement of cash flows is going to change a little bit. The first couple slides we'll go through quickly because we just talked about them, but you can go back if you need to and kind of take a look at what we were talking about when it comes to operating, investing, and financing. And one thing to keep in mind when we're talking about cash is that we are talking about cash is not necessarily just the money in your pocket. It is your checking, your savings account, and anything that's highly liquid, which is mean that you can get to it within 3 months. All right, so it could be some short-term CDs or anything like that. This is what a statement of cash flows looks like when it's completely condensed. So you really aren't seeing the details, but you can see the operating, the investing, the financing, and then you also can see the net change, the beginning of the year, the end of the year. And then one thing, especially when you're doing your homework, this comes into play. When you see this, that it says cash provided, used, that means they're giving you both words. So for example, operating activities, it shows 310 with no parentheses. That means provided. That means it was a plus $310 million. Under investing activities, because there's parentheses around it, that means that it used up $380 million. So if there's parentheses around the number, it was used. If there's no parentheses around the numbers, then it was a positive. It was provided. So that really tends to throw people off when they're trying to do their homework. And that will be a question that I'm asked by a couple people that weren't here trying to do the homework. And then the cash and cash equivalents. I don't know if you remember from the very first night, I told you that the cash in the balance sheet account should equal the end of year cash in the statement of cash flows. So that 250 is the number that we want to make sure equals the cash in the balance sheet. That's just a check figure. All right. So operating activities, we kind of talked about this again. So there are basically things that are going to provide by collecting from customers, purchasing goods and services, salary and wages, income taxes, things that are normal day-to-day activities. Investing activities, like I said before, we talked about purchasing things. Down here, it kind of shows you how it came up with the 380, purchasing equipment and purchasing intangibles. And then financing, borrowing money. And remember I said you never know how they came up with the amount. This is a perfect example. If you look at the cash flows provided by financing activities, they borrowed money, then they paid back money, then they issued stock, and then they paid a dividend, and they ended up with a positive cash inflow of $190 million. So they actually paid back a loan and they paid dividends, but because of the other borrowings, they had a positive cash flow. So in financing activities, you really don't know what's going on until you go in there. Now, I'm trying to decide the best way to show this. So when we've had our operating activities, we're going to break out our operating activities. And one of the things that we had talked about was that it's day-to-day activities. And then we have our investing and our financing. So if we think about our day-to-day activities, and we think about what goes on in a day-to-day, and we try to think about our balance sheet, what on our balance sheet would be something that would be day-to-day? Well, is that something we're going to buy day to day? No. Cash. And more like cash is there, and how do we classify that on the balance sheet?
As a current asset.
As a current asset. All right. And then what else could be on the balance sheet that's opposite of a current asset?
Notes payable.
And well, not notes payable, because that wouldn't be something that did day to day. What's the What's a day-to-day equivalent of notes payable?
Current liability.
A current liability. Accounts payable, right, current liability. So day-to-day activities would classify to current assets and current liabilities. Investing activities, we said, were property, plant, and equipment. What would we call that on the balance sheet? Think about it. What is property, plant, and equipment?
Assets.
What kind of asset?
Non-current assets.
Non-current asset. And then financing activities, we said, were loans, stocks, and dividends paid. So what do we classify loans as? One of you guys already said it earlier.
Liability.
Liability. What kind of liability? Is it a current liability?
Non-current.
Non-current. Thank you. And then, what would we classify stocks and dividends as? What's the last thing on the balance sheet that's not here? We have assets, liabilities, and stockholders' equity. So we're able to take the statement of cash flows and break it out into the balance sheet. Operating activities is current assets and current liabilities. Investing activities is non-current assets. And financing activities is non-current liabilities and stockholders' equity. So do we see how those items relate to those areas?
Yeah.
Yeah, a little bit. Okay, so then I'll go to the next slide. Slowly. So here's our operating, our current non-current assets, our non-current liabilities, and they're just trying to show here investing is non-current assets, and then the purple is the financing, which is the non-current liability and the stockholders' equity. And this is important because we're going to now go into the statement of cash flow. So that's why we're trying to show you how those activities relate to the balance sheet, because in order to do the statement of cash flows, you need to know how they classify back to the balance sheet. All right, and we'll be using the income statement and some additional information. We're going to skip through that because that tends to confuse you guys. So there are two different types of statement of cash flows, of course. We have the direct method and we have the indirect method. All right, no matter which method we use, they both have the same answer. All right, the only difference between the two methods is the operating activity section. The financing and investing section are exactly the same. All right, we're going to be focusing only on the indirect method because the indirect method is GAAP, generally accepted accounting principles. The direct method is not GAAP, and therefore you can't follow it if you're going to be doing financial statements for the SEC or for accrual-based accounting, which is what we are doing. So we will be doing the indirect method. The direct method is at the end of the chapter, but we will not be doing anything with the direct method. All right. It is important to note that in the end, you have the same number. The reason investors like the indirect method is the indirect method starts with net income. And it takes a company's net income and then shows them how much of net income is actually cash. Because remember, net income has nothing to do with cash. Net income only shows you how much revenue you made and how much expenses you used. You could have earned and gotten the cash for that revenue 6 months ago and just earned it. And like we talked about in prior, last week and the week before, especially in today's world right now, money was paid a long time ago for a lot of activities that will not be taking place for a much longer period of time. Some are getting refunds and some are not. The Kenny Chesney concert that was scheduled for June 13th, I think it was, is rescheduled for 2021. And as long as you want to go, then you're not getting a refund. So that means you paid for this concert back in November of 2019, and you will not be getting any refund, and Kenny will not be able to recognize the money as earned until 2021. That's a very long time. All right. So the indirect method of the statement of cash flows is showing how much of your net income is actually collected in cash. All right. This is not where I'm going to stop, I don't think. Let me look. 12:03. Okay. All right, so the first thing we're going to do is we're going to start with net income, and then we're going to add in what we call our non-cash items. We have 2 non-cash items. Those non-cash items are depreciation and amortization. And what I mean by that is depreciation is never, and I don't use that word very often, never going to have cash. And when we did our adjusting entries, remember, depreciation and depreciation expense were the only journal entry that did not have a cash before it or a cash after. All right, amortization is the same thing. They are our only non-cash transaction. And that is a hint of a phrase you might want to remember for a test, that depreciation and amortization are our only non-cash transactions. Right? You will never spend cash on them. The journal entry is a debit to depreciation expense and a credit to accumulated depreciation, and that's all that ever happens. Because think about that. When we depreciate our car, are we ever actually going to spend cash on that, or is that just an estimate of how much our car is actually being used? Does our car actually go down in that exact amount of depreciation? No. They tell us when we drive off the lot with a new car that our car goes down drastically in value, but we really don't know how much it goes down in value until we try to sell it. All right. So when you look at the income statement and you have net income, that's revenue minus expenses. If you have $10,000 in revenue and $1,000 in depreciation expense, it looks like you only made $9,000. But if this was depreciation expense and this was all cash, didn't you really make $10,000? I think someone has their mic on that might want to. I don't know if it's bothering anybody or not, but just keep that in mind. But isn't that true? If you have $10,000 and the $1,000, your only expense was in depreciation, didn't you really make $10,000? Yeah. All right. So now, let me make that go away so we have room to write. Then we're going to look at changes in our non-cash current assets and current liabilities. So what do I mean by that? I mean, we're going to look at things that affected current assets and current liabilities, but didn't actually have an effect on net income. So we have to go in and make that effect. And then, of course, we have any gains or losses, which we will go in and make that change to. All right, so this is a good slide to kind of take a look at, and a good slide to look at. So this is, I write it usually horizontally, whichever way I start from net income. I always say you add in depreciation, and then you add in when a current asset is going down, and you subtract when a current asset is going up. That's my up. That's a bad up. Let's try that again. When a current asset is going up. And then you add when a current liability is going up, and you subtract when a current liability is going down. So liabilities go in the same direction, and assets go in the opposite direction. All right. Now, I will try to give you guys a couple of examples of why this happens, and I'm going to go to a whiteboard in order to explain it because there's not enough room on here. Okay, so when you have net income and you think of a current asset that is going down. So when a current asset or current you have changes in current assets, you have, for example, rent expense and prepaid rent. So if rent expense and prepaid rent changes for $1,000, and here's our net income. Our net income was $10,000. We added in $1,000 for depreciation. So down here we have revenue. Let's not put it there. I will run out of room. We have revenue of 12,000, and then we have expenses of 2. And so that gave us a net income of $10,000. Okay? All right, so we already added back in our depreciation expense of $1,000 that we had, and this is our net income. So now, if this was a journal entry that happened, and our prepaid rent was going down, look what happened to rent expense. Expenses were increased for $1,000. But did we spend any cash on that expense? We did not spend any cash on that expense, which means we increased our expenses by $1,000, which decreased our net income, but we didn't spend any cash on that expense. So if that's the case, we want to add $1,000 back in because this journal entry decreased our net income by $1,000 because it increased expenses. And that was because our current asset of prepaid rent went down. Right? Another one would be if a current asset is going up, accounts receivable. See if I remember this one. Revenue, $2,000. So our accounts receivable is a current asset that is going up. Revenue went up by $2,000. So that increased our net income by $2,000. However, did we get cash for that revenue? We did not. But yet it increased our revenue, which increased our net income. So we need to come over here and subtract $2,000 because this journal entry increased our net income, but yet we did not get any cash. And all we're trying to do is figure out how much of that $10,000 was actually cash. And that $2,000 was not cash. Same thing we can do on the liability side. So if a liability goes up, it could be wages expense, wages payable, $500. So wages payable is a liability and it's going up. We increased our expenses by $500, which made it look like we decreased our net income, but we did not spend any cash on those expenses. So therefore our liability went up. So we need to add that back in because we didn't spend cash, but yet we took it out by adding it to expenses like we did. And that's because of the wages payable. And the last would be a liability going down. And deferred revenue, is that one going to work? Deferred revenue and revenue of $1,000. So deferred revenue is making a liability go down. We added $1,000 to revenue, which made our net income go up, but yet we did not get any cash. So it makes it look like we got money, but we didn't. So we need to subtract that out. So when we're done, 12,000, 10,000, 9,000. Based on my example, then we actually had $9,500 in cash out of the $10,000 that we showed in net income. Now, you don't need to be able to do examples like this and show me examples. I'm showing you those so that they can go along with the slide that I showed you, and they can go along with this aspect right here. That a current asset going down is added, a current asset going up is subtracted, a current liability going up is added, and a current liability going down is subtracted. Do you have any questions? Because we'll walk through an example if you're good.
Hold on a second. Let me
Okay.
write this down.
Nope. You tell me when. All right. So the example we're going to do is with Under Armour. So Under Armour is already going through and giving us the change. So sometimes, like in your homework or in a problem that we will probably do based on time, we'll see. Sometimes you have to do some calculations and you have to subtract. Now, if you have to do the subtracting, one thing to keep in mind is this is the current year, this is the old year. So you are subtracting going this way. So in other words, it went up 120,000. So you have to make sure you're subtracting the right way. All right, so this is the first page. This is the first page of the balance sheet. Second page. And then we got the income statement. All right, so in order to start this, we are going to need to start with $260,000. So we would start with net income. Now this is going to be piecemeal writing, so because the screen's going to change on me. So if you're writing it yourself, you want to start with net income of $260,000. All right. Then the first thing you're always going to do is add in depreciation. Okay. So we can get that from the same place you get your net income. If you go up, depreciation expense is 110. Now you don't need to do this. I'm going to do it so I have the number in my head, but that's 370. So that's what I'm going to use moving forward. Okay. But net income plus depreciation expense. After you have those two numbers, then you need to go and start looking at your current assets and your current liabilities. So we're going to back up 2 screens. All right, so now I have my, what was it already, 370. And now I'm going to start looking at my current assets. So what is my first current asset?
Cash and cash equivalents.
Cash and cash equivalents. Okay. And that is always my first answer. But I want to tell you, we do not use those numbers. Keep these 3 numbers in your head because we will come back to them. Do you remember about 8 slides ago, I told you something about this number, 250. What was it? cash at 250 needed to equal something. Do you remember what it was?
The balance sheet.
Exactly. So we're not going to mess with that, but we'll come back to it, okay? So my first one is actually going to be accounts receivable. So accounts receivable changed. It went up. That's what that plus means. It went from 520 to 620. So if accounts receivable went up by 100, what are we going to do?
Add.
Okay, so if you've been taking notes, what did we say we're going to do when a current asset goes up? Yeah, current assets go up, current assets go down, current liabilities go up, current liabilities go down. When a current asset
I
goes...
can't see your computer.
You can't see it? At all?
No, I don't see it. No, I don't see it. It went off.
I don't see it either.
Okay, that's not making me happy. Okay, because it's still showing that. You're not seeing the computer, you're not seeing me writing.
We're not seeing you writing.
Okay. Let me try to... That cash for 250, all the cash numbers from the very first page are right here. This is beginning cash. This is ending cash. And that was the change in cash. That's why you don't use them when you're calculating operating activities that go into this number. Because that's the beginning, ending, and change. And that 250 is what we need to end up to. So when we add the 310, when we add the, 380, and we add the 190, they better plug to get those numbers that we already had. Otherwise, we got a problem. Now, do you guys remember the 3 things that I said were exceptions at the very beginning of class? Do you guys remember the 3 things that I said were exceptions to operating activities? What were those 3 exceptions? Or what was one of them? You guys don't remember one of them?
I don't know if it's affecting anybody else, but your audio is going in and out for me.
It is.
Yeah, same here.
Oh, okay.
Yes,
All right. I am.
going down. Yeah, like flagging.
Okay. I will call in on my phone to see if that makes a difference. The question I ask is, does anybody know, was it going in and out for a while or did it just start? Okay. Hang on a second. Oh. I just lost it. Let's go work a problem. So go to, in your working papers, it is M12-6.